Welcome, everyone. I am absolutely thrilled to have you here for this explainer. Today, we're pulling back the curtain, really setting the stage to uncover the behind-the-scenes mechanics of payroll accounting. We're going to take what, usually looks like a terrifying maze of numbers and transform it into a clear, logical, and highly structured system. Sound good? Let's get into it. So, here is a question every single business owner, manager, and payroll pro really needs to ask themselves. Where does the money actually go after you hit run payroll? I mean, we all kind of tend to think that payroll just ends the second a paycheck is issued or when that direct deposit clears the bank. But in reality, that's just the starting line. It is the beginning of a completely crucial financial journey that literally impacts the health of your entire organization.
Okay, let's dive into this. Here is our roadmap for today. 1. We'll look at the 5 account types. 2. We'll decode debits and credits. 3. Break down the anatomy of payroll entries. 4. Look at the impact on financial statements. And finally, 5. Reconciling for financial health. Let's move.
Section 1. The 5 account types, the building blocks. So, to understand the flow of the money, we first have to understand the path it takes. Every single financial transaction follows this really specific, rigorous life cycle. It always begins with the transaction itself, like, say, an employee working their shift and earning their wages. That transaction gets recorded in journals, then it's posted to a general ledger, and eventually the whole thing ends up on the organization's macro financial statements. It's actually a beautifully systematic flow once you see it.
And that general ledger, it's organized into 5 fundamental account types, usually numbered to make them super easy to identify. Think of these as your 5 primary buckets. You got assets in the 1000s, liabilities in the 2000s, equity in the 3000s, revenue in the 4000s, and expenses up there in the 5000s. Now, when we're talking specifically about payroll, we are primarily interacting with just 3 of these buckets: liability accounts for the money we owe out, expense accounts for the actual cost of our labor, and asset accounts, like the cold hard cash in the bank that we use to actually pay our people.
Section 2. Decoding debits and credits, the mechanics of movement. Okay, so the entire foundation of this whole process rests on the accounting equation, which absolutely must always stay in perfect balance, no exceptions. We pull this off through what's called double entry accounting. It's basically a standard method that requires every single transaction to be recorded in at least 2 accounts. You have a debit entry on the left side of a ledger and a credit entry on the right. And the golden rule you need to memorize: total debits must equal total credits. It creates this punchy, rhythmic energy that keeps the whole financial system perfectly honest.
And this brilliantly illustrates how those debits and credits actually change our account balances. Look, each account type has what we call a normal balance. For assets and expenses, their normal balance is a debit. So if you want to increase your wage expense, you debit it. It's that simple. On the flip side, liabilities, equity, and revenue have a normal credit balance. So when you owe more money to the government for, say, payroll taxes, you credit a liability account to increase it. Doing the exact opposite, like crediting an expense or debiting a liability, well, that decreases those balances.
Section 3. Anatomy of payroll entries, building the recipe.
Before we start throwing numbers around, let's look at the structure itself. A standard journal entry is essentially just a summary of your payroll register data, all nicely formatted for the general ledger. To do this right, it absolutely must include a reference number, the date of the transaction, the specific debit and credit amounts for each account, the perfectly balanced totals, and a brief explanation of what the transaction actually was. Basically, this is how you build a rock-solid audit trail.
All right, here is the actual recipe for a basic payroll entry. Following the rules we literally just went over, the employer's total labor cost gets recorded as a debit to the salary and wages expense account. Simple enough, right? But wait, the employees don't actually take all of that money home. So we credit liability payable accounts for the amounts we withheld, things like taxes, employment insurance, maybe pension contributions, simply because we owe those funds to third parties. And finally, we credit a clearing account, typically called salaries payable, for the net pay we actually owe directly to the employees. And just like magic, the debits perfectly equal the credits. Section 4. Impact on financial statements, micro to macro. Let's move to and see how this builds into our final financial destinations. Taking it from the micro to the macro, the accounts we just use end up living in 2 totally different places. Our wage expenses, those head over to the income statement, which tracks your profitability over a specific period, and then, this is important, clears to 0 at the fiscal year end so you can start fresh. However, our liability accounts, remember, that's the money we owe, those go straight to the balance sheet. And here is the absolutely crucial difference. Liability balances do not clear at year end. They stubbornly carry forward, year after year, until that specific debt is actually paid off. Which leads us to a pretty terrifying question. What happens if an employee's payroll expense is accidentally keyed into the wrong account? Just think about it for a second. A single unbalanced entry, or even just a slightly misplaced decimal, doesn't just quietly stay hidden in the payroll department. Oh no. It flows directly to the general ledger, significantly distorting the macro financial statements that management and external stakeholders rely on to make massive business decisions. It is a huge deal. Section 5. Reconciling for financial health, keeping the system honest. So how do we catch those mistakes? Account reconciliation. This is the rigorous process of proving that the general ledger balances are actually correct. It comes down to 3 discipline steps. First, reviewing all transactions posted to the accounts. Second, meticulously matching those transactions with supporting documents, like your payroll register or government remittance forms. And third, investigating and immediately resolving any discrepancies you find. This process is literally your primary defense mechanism for catching incorrect entries, duplicated charges, or worst case scenario, straight up fraudulent activity. So the crucial point is this. Let this really sink in for a moment. Because there are heavy, legally binding compliance requirements related to payroll withholdings, these liability accounts must be examined in fastidious detail. When you look at a payroll liability account, the balance you see must exclusively represent a legitimate upcoming future payment. It absolutely cannot be hiding a missed remittance to the government or a third party. It just can't. I really want to leave you with a thought to deeply ponder regarding your own organization's financial health. If your payroll liability accounts were audited today, like right now, would they accurately reflect well-managed upcoming payments, or would they uncover hidden missed remittances? Truly understanding this financial flow, from a single employee transaction all the way to the final balance sheet, is exactly what empowers you to ensure it's always the former. Thank you so much for joining me on this explainer, and keep learning.